Hey everyone, and welcome back to my channel, Physician, Finances, and Investing. I'm Joe, a resident physician. Do I even have to say it? Alright, let's talk about how to get that bread. Hey everyone, welcome back to the channel. In our last video, we spent some time talking about some basic information that all beginner investors need to know. You guys know the deal. If you missed that video, I'll put a link to it right up there. In today's video, I'm planning on keeping it brief. I'm going to teach you guys something simple and then get out of your way. I know you're all busy. In today's video, we're going to continue to focus on the beginners out there. Those of you who are just getting started and have some questions about some of the basic concepts. I got all the basic questions, man. I need help with it all. That's right, Average Joe. I'm focusing on you. In today's video, we're going to be discussing mutual funds and ETFs, also known as exchange-traded funds. My goal for this video is to compare and contrast these two investment options to give you guys a basic framework to help understand what both of these options entail. In order to begin this conversation, we first need to talk about what exactly a mutual fund and an ETF is. Mutual funds and ETFs are essentially baskets that hold multiple different stocks within one investment product. Now, they can include things other than stocks, but for the sake of today's video, let's just keep it simple and talk about stocks. I'm sure we've all heard the saying that you shouldn't put all of your eggs in one basket whenever you're investing. Basically, meaning that you shouldn't put all of your money into one single stock investment. You need to diversify. Now you might be saying to yourself, Joe, I'm just getting started. I would love to be able to buy a ton of different stocks and be diversified, but I just can't afford it. That's why mutual funds or ETFs might be the investment option for you. By definition, both mutual funds and ETFs are inherently diverse, meaning that they hold multiple different stocks within one investment product. Or you might be saying to yourself, I don't really want to invest in individual stocks. I don't want to put my money into 3 stocks and just hope for the best. Well, if that's the case, then ETFs and mutual funds might be great investment options for you as well, since they're able to give you a diverse holding of multiple different stocks within one investment. So with all of that being said, the next thing that I'd like to spend some time talking about are the different types of mutual funds and ETFs that you have available to you. When it comes to broad categories, there are 2 different types of mutual funds and ETFs, active and passive. Now, this information isn't as important unless you want to talk about some of the finer details whenever it comes to investing in mutual funds and ETFs. Now, a passive mutual fund and a passive ETF basically mean that there's no fund manager guiding the ship. They sit down with their goals and their objectives for the investment and throw some things together into the basket and essentially say, that's good enough. We don't really need to do anything else. So for you as the investor, that means that you're going to pay a little bit less for these investments. This would be things like index funds, where the fund manager tries to mirror how a particular index performs. It could be the S&P 500, maybe the Dow Jones, or maybe an international index. Honestly, it could be anything. So these are the passive mutual funds and the passive ETFs. They tend to be less costly to you as the investor since you don't have to pay as many fees. Now, sure, you are still going to have to pay some fees, things like administrative fees and things of that nature in order to allow the fund to keep the lights on, but in general, it'll be less costly to you. Now, active mutual funds are just as the name implies. There's a fund manager who is actively managing and changing the investment in order to meet the goals and objectives of the fund. There are also some active ETFs as well. Many mutual funds, and in fact, actually most mutual funds are actively managed. Now, sure, you have your index funds like we just previously talked about, but in general, most mutual funds are actively managed. Things like your target date retirement funds or your growth stock mutual funds are active mutual funds. Now, in contrast, ETFs tend to be passive. Now, sure, you still do have some ETFs that are actively managed, but in general, most ETFs are passive funds that track how a particular index or maybe even a particular sector of the economy is performing. So if you're thinking that you as an investor would rather be invested in something that is passively managed so that you're paying lower fees, then maybe an ETF would be a good investment option for you. Now, as we've already implied, regardless of if you choose to invest in a mutual fund or an ETF, it's going to cost you, the investor, some money in terms of fees. So let's move on to talk about how to compare and contrast the cost of a mutual fund with the cost of an ETF. Whenever you're researching mutual funds and ETFs, the number that you want to pay close attention to in terms of the cost of fees is called the expense ratio. There are multiple different websites that you can use to research expense ratios. Personally, I like to use a website called Morningstar. So for the numbers that we're about to discuss, that's where I got all of this information. So when you're comparing different mutual funds and ETFs, the number that you want to look at is the expense ratio. Now, as of making this video, the current average expense ratio for actively managed mutual funds is 1.1%. Now, this is just an average. Certainly, you could find some mutual funds that have a lower expense ratio and some that might have a higher expense ratio. In contrast, the average expense ratio for actively managed ETFs right now is about half. It's 0.6%. So already with that information alone, you might be saying to yourself that, okay, if I'm comfortable with an ETF, then this might be something that I should look into more. Now, as of making this video, the average expense ratio for passively managed mutual funds is 0.8%. And as we've already mentioned, this is just an average. Certainly, if you did some research, you might find some that are better, you might find some that are worse. In contrast to this, the average expense ratio for participating in a passively managed ETF right now is about 0.5%. And again, if you did some research, you may find some that are cheaper. This is just an average. I mentioned these averages to encourage you guys to do some research to compare and contrast all of the different options that you have available to you. Some additional information that you want to look at whenever you're comparing different mutual funds and ETFs are their goals and their objectives. For the sake of this discussion, I want you guys to think about this as a business plan. So, for example, if you were hoping to start a business, you would come up with your own business plan. The market that you're hoping to target, what you're trying to sell, what your profit margins are that you're hoping to achieve, and what expenses you're willing to incur. Mutual funds and ETFs are no different and have their own business plan, which they call their objectives. This information is available to any potential investor in the form of the fund's prospectus, which essentially is a bunch of paperwork that talks about what the fund's goals are, how they hope to achieve them, and how they plan to get money back to their investor. So like we were just talking about a few moments ago for actively managed mutual funds, they're just that. They're being actively managed by the fund manager. If they feel that a particular area of the market is about to become very strong or very weak, then they can make major adjustments to how the fund has their funds allocated. Fund managers are very incentivized to make sure that they're performing well with their actively managed funds because, well, let's face it, if they're not doing well, they could lose their job. And all of this information is available to you as the investor, so you can track how a particular fund has been managed over the past few years. Like we mentioned for ETFs, however, they tend to be more passively managed. So for you as the investor, you're basically just along for the ride. If the ETF that you're invested in is tracking the S&P 500, then you as the investor are basically saying that you want to be along for that ride with hopes that your money will perform the same way that the S&P 500 does year over year. The last thing that I'd like to talk about is how mutual funds and ETFs are traded, meaning how you as the investor buy and sell that investment. Mutual funds are only bought and sold after the market is closed, which means that throughout the course of the day, you as the investor cannot get into the investment and you cannot get out of it. Yes, you are able to place the order, but that order will not be filled until after the market is closed for that day. In addition, mutual funds have to be bought by the company that's offering it, meaning that you can't buy it on the open market. I can't sell it to you and you can't buy it from me. ETFs, however, trade just like individual stocks. So, for example, you might decide to buy a share of Apple in the morning and then change your mind and decide that you want to sell it at 1 o'clock in the afternoon. For ETFs, you can buy and sell that position at any point when the market is open, and sometimes even after the market is closed. Now, I know some of you may be saying, Joe, I'm a long-term investor. I have decades until I need my money for retirement. And I understand that. You don't really care what the fluctuation is from one day to the next. You're thinking more decades into the future. But we're all human, and we all sometimes like to buy things for a discount. And ETFs offer you that opportunity. With ETFs, if you wake up one morning and see weakness in the market, you're able to take advantage of that weakness at the moment and decide to invest more money. With mutual funds, however, you're unable to do this. Your order will only fill at the end of the day once the market is closed. That concludes the information that I wanted to cover in today's video. Just a basic overview of mutual funds and ETFs. That way, for some of you guys who are just getting started with investing, you now know some of the similarities and differences between mutual funds and ETFs, and now can do your own research to learn more about them. As a reminder, I'm not a certified financial planner. I'm a resident physician who recognizes the importance of taking an active role when it comes to managing your finances and wanted to encourage others to do the same. So with all of that being said, I encourage all of you to do your own research before making any financial decisions. That concludes another episode of Physician, Finances, and Investing. I hope that you guys found this video both fun and informative. If you have any questions or would like me to talk about a particular topic in a future video, please feel free to comment below and I'll be sure to get that information to you guys. And if you haven't already, please smash that like button and click on that subscribe button to let me know that you like what we're doing here on Physician, Finances, and Investing, and to help support my channel. Thanks everyone, and have a great day.